In this week's 3 Top Picks, I'm speaking to Robert Mann from Nikko Asset Management. He's touching on the South Korean equity markets, Indian property, and how China's changing consumer dynamic is creating opportunities for domestically based companies.
So Korea is an interesting market. So it's always been the cheapest market in Asia, and one of the major reasons has obviously been the North Korean risk that's been there since I guess the end of the Korean War. And so in some respects, the recent sort of noise about late last year, early this year about Korea, the markets didn't really react negatively because it's already in the market. So there's a huge potential upside, it seems to me, to Korean shares if we can make progress sort of on peace on the Korean Peninsula. Now, I'm not saying it's going to happen because that's clearly very difficult to forecast what will happen. But from a situation where you were very concerned about what would happen, and any reduction in hostilities or in animosity is clearly be a very, very good thing for the market. So I think that's an interesting market to look at. There are clearly some world quality companies in Korea. The electronics space, Samsung is clearly the largest company in that market. They've done a good job at selling sort of some of their consumer sort of brands into China in particular, the whole Korean wave thing on sort of pop music, Korean culture. So there's a number of areas where Korea's done good things. Any news on North Korea I think is probably got to be positive because the market has been expecting just so little.
And Robert, how is the shifting from a black market towards a more formal economy in India impacting the property sector there?
Traditionally in India, the property sector was not really part of the formal economy. A lot of black money used to be used to buy property. So the whole move to sort of formalise the economy helps the listed property developers at the expense of the unlisted guys. And whole part of the whole formalisation clearly helps the whole listed sector as against the broader economy. And so we think that the good property developers in India that are listed will do very well. So it's not as if there are that many of them, but there are 2 or 3 that we think very, very highly of and are happy being overweight.
Now finally, on China, you're speaking about the Chinese consumer opportunity and specifically on the retail products and in the education services. How do you see these opportunities evolving over time?
Everyone knows the China consumer story. It's been talked about sort of for a number of years. We see in the Australian New Zealand markets, companies like A2 Milk that sort of can crack it, can do unbelievably well. So the demographics in China clearly favour consumption. Government policy is moving once again in favour of consumption and services. So you've got massive tailwinds behind the sector. So the real question is, who will benefit from the growth in Chinese consumption? Will it be foreign firms, the A2 Milks, the McDonald's, the Nestle's? Will it be other Asian firms, so the Korean cosmetics guys, or will it be the Chinese consumer firms? And I think that going forward, it'll be more and more the Chinese consumer as their tastes get more complex, that they are feeling less of an inferiority complex, that foreign must be better, as they get the food safety standards inside China moving higher, that the good marketing, the Chinese consumer companies that are very good at consumer marketing are getting a bigger and bigger market share. Now, it doesn't mean every sector that will happen, but I think there are more of them to do that. The other thing that the Chinese consumer does like, and all the surveys show this, is that it's spending on education. Education is clearly a very important part of Chinese culture. So effectively the cram schools, or to help the kids, they're all in China. Obviously, Australia sees some of it in sort of the university end of it, but the bulk of the money is obviously spent from kindergarten up to the end of year 12. So that's an interesting sector. It is getting very expensive at the moment. We'll be very careful of stock selection in that sector. But we think that in general, it'll be more and more Chinese companies who understand their consumer and it's a very competitive market and things change very quickly. Being on the ground is pretty important, which doesn't mean that a KFC, which has done very well in China, sort of can't do it. But just to assume that because a brand does well overseas, it'll do well in China, I think is too simplistic and actually quite dangerous.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.